Ladies and gentlemen, welcome to ICISA State of the Industry. This forms part of our monthly series of webinars with varying topics across the trade credit and surety world. We organize these webinars as a service to our members and to the public at large. Some of these webinars are members only and usually cover technical topics such as underwriting in times of inflation. Others are open to the general public, such as our previous webinar in May on measuring carbon footprint or applying the PCAF standard to credit and surety. You may find all of these webinars, as well as this one, to review on our website icisa.org under the header Resources. Now let's get into this. With over 100 registrations for this webinar, this tells us that there is a need for more information about our sector of industry. ICISA is in a position to provide an overview because we get direct feedback from members in the various meetings that we have. So 3 weeks ago at this time, we were all in Brussels at our annual general meeting week with technical committees and with our AGM. And we get a lot of feedback from this. What we also get is a lot of quantitative feedback, which I will share with you from our annual data gathering exercise. And that is to gain a good overview of what our members are doing. And our members, as you would probably know, are largely private credit insurance and reinsurance companies, as well as sureties, which serve our industry. And that annual data gathering exercise also serves as a good benchmark for our industry. And last but not least, to prove that we have a functioning private market for surety and trade credit insurance on a worldwide basis. Another source of information for us is our contacts with regulatory and official bodies and other organizations representing our industry. You can think of ITFA, the International Trade and Forfeiting Association, FCI, our factoring colleagues, and PASA, the Pan American Surety Association. And that means nothing that will be said today is actually invented by ICISA. And I thank all our sources and I'm happy to have them. Now, what we'll be discussing today in the next 30 to 40 minutes is the general environment of the past few pretty turbulent years and our consequences for today's market. Secondly, the facts and figures split by subclass of business, trade credit insurance, single and political risk business, and surety. So it shows how we do it. Thirdly, comments on the underlying trends that can be observed in today's market. Basically, distribution, new products, new markets, and last but not least, reinsurance. I will touch on an update of what is happening on the regulatory side, notably Solvency II and its offshoots, the consequences of impending Basel rules on our sector, and sustainability, which underpins everything we do at ICISA. And I will end by gazing in my very cloudy crystal ball and try to do some predictions for the future. At any point, you may enter questions or comments using the questions button on the lower right-hand side of your screen, and I will attempt to answer these after this presentation. So setting the scene, and let me start with the conclusion. What we see is the market is doing what it's supposed to do. And what are we supposed to do? We are supposed to act as a shock breaker. Insurance and reinsurance are equalization mechanisms. We see this in the way that our members are taking on additional risk in times of insecurity. What are we supposed to do? We are supposed to supply sustainable capacity based on underwriters making a fair return on their capital. And that enables us as a sector to be predictable, to our clients. And this is what they ask, a stronger demand of us. We act as an early warning mechanism. Policyholders are usually not interested in claims and getting their claims paid. What they're interested in doing business, good business. And we help them do that. And lastly, what are we supposed to do? Is take responsibility for society-wide issues. The prime one being sustainability. I'll touch upon that later. Now, it's good to see that market participants have different strategies and views on issues ranging from the economy to the future of sectors and companies. And it shows we have a real and a vibrant marketplace where not everyone is selling the same product and the same variation of the product. That's what you can expect of us. Now, if I look at various crises that we came out of, firstly, it's COVID. And I'm not going to introduce COVID to you because we've all lived it, right? What I will say is that COVID for our sector was characterized by lots of government measures, basically flooding the economy with liquidity in the form of subsidies, in the form of credit guarantees, delayed payment for tax dues, and measures to keep employees on the payroll of every company within the jurisdictions that were supported. What we also saw is a protection for credit insurance buyers in the form of government reinsurance. Now, I'd like to stress again, and we never get tired of this, that this measure was put in place for the buyers of credit insurers, the policyholders, not for the insurers. They actually lost a lot of money on it. What it did do is it provided some predictability at the start of the crisis and took some jitteriness out. However, if you look at that government reinsurance and all the measures that flooded the economies with liquidity, we see it a bit as belts and braces together. The measures each had at least partly their effects. Together, we're not sure if that actually worked, especially after the first couple of months. What we did see was a total lack of insolvencies. Firstly, by that liquidity, but also in a number of jurisdictions, it was practically impossible to have a company declare insolvency. Now, seeing a greater prevalence of government involvement in private markets is a bit of a hangover from the pandemic. It comes from the past crisis, but will continue in the future. And an example of this is the European Export Credit Facility. If we look at geopolitical tensions, and that is basically the Russia-Ukraine conflict, supply chain disruptions, and changing global trade, and the latter has a very clear example. Chinese exports to the US and the EU dropped by 15% and 5% respectively in the first 5 months up to June of this year, compared to the same period in 2022. By contrast, exports to ASEAN countries grew by 8%, and this 10-member bloc is now China's biggest trading partner. Worldwide trade flows are changing. Turning to Russia, Ukraine, whether this conflict is the sole cause of food inflation is certainly debatable, but it hasn't helped. It certainly did cause an uproar in the energy market. The supply of energy to Europe has certainly undergone a major change since the start of the conflict. LNG is now an essential import to satisfy the energy of jumpy Europeans. What the events have most certainly caused is a surge in inflation with resulting increase in interest rates. And if we make a bridge from this to the economic position at this point, When looking at the economic prognoses of official institutions as well as our members, we see one thing. If you don't like the economic forecast, just wait for a couple of months and they would have changed. So 1 year ago, the consensus of global economic growth forecast stood around 3%. This started to look much more optimistic in the first quarter of 2023, this year, only to turn again in Q2 with Western European countries coming to a soft landing or even a mild recession. Advanced economies are now not expected to grow with still higher inflation and tighter financing conditions. This constrains consumer spending. And if we want to see the fallout of that on financial markets, you only have to look at the MSCI World Index. You probably know it. It's an index of more than 1,600 securities across large and mid-cap size segments in 23 developed markets. Although weighted towards the US, the picture is clear. We see a low in 2020, clearly COVID related, climbing steadily until the end of 2021, and then all of a sudden falling some 22.5% until October 2022. Then climbing 11% until the end of January of this year, and falling again by about 5% to its low in March, and climbing back by some 10% to where it is now. Now, that's what I would call volatility. An old stock market wisdom says extreme volatility is a harbinger of a crash. Whether that's the case this time, nobody knows, but it doesn't look good. But it also papers over vast regional differences, from slow economic growth or even stagnation in countries like Germany and the UK to a much healthier outlook in the US and in India. Insolvencies are rising, unsurprisingly, given the inflationary pressures and the interest rate rises. A sign of uncertainty is also the re-emergence of large balance sheet fraud, lojas americanas among them. Now, Warren Buffett is rumored to have said, when the tide goes out, you see who's been swimming naked. And now is the time that we actually see that. Now, the big question is whether we're the boy who cried wolf, no pun intended. The predictions on the result of the credit and surety industry at the start of COVID were dire. The world was going to end, Armageddon was coming. When the war in Ukraine broke out, this was repeated. And guess what? The loss ratios in the industry on the whole barely budged. Notable exceptions there aside. So what would be different now? Now, we could point to that it was a long time since a recession, or that the stacking up of all these challenges needs to lead to a higher number of insolvencies at some point. We can point to inflation and the resulting rise in interest rates. And I'm sure we can dream up many other scenarios. But rather than taking a stab at this, let the market answer this. The demand for our product has never been as high as it is today. I see this in the figures of our members. I hear it from those members. I hear it from brokers and other market participants. So this is probably a good time to take a look at some figures. Figures come from our standard annual report exercise. And here you see the report on trade credit insurance and on single risk and political risk insurance. Now there's a difference. We define trade credit insurance as largely a whole of turnover policies, so policies which cover all buyers of the policyholders, and policies that cover discrete segments of the policyholder's debt portfolio. And these segments can be defined by product sold, by country, by size of commitment, or any other objective measure. Single and political risk is what it says on the tin. When a policyholder chooses to seek cover for one buyer, for instance, a buyer of milk powder in Algeria, or exclusively against the political risk in a country or a group of countries, that is single risk or a political risk policy. That political risk can be the risk of war. Does it happen? 3 years ago, we would have said, well, at least not close to home, right? It covers lack of convertible currency in a country or any other country-specific risk that is not influenced by the buyer or by the seller of the goods. Incidentally, these political risk elements are usually insured in whole turnover policies and single risk policies as well. Now, let's look at the figures and start with trade credit insurance. We see a 13% increase in premium. On the plus side, the push side, we have to note that inflation has had quite an influence on this. If the price of goods being shipped undercover increases, you will also, either at the same time, depending on the policy, or 1 year later, you will see the premium rising. But there is also a much higher demand from the market. And one of the publications that I like a lot is the Insights published by Aon Credit Solutions. They clearly state this. What also has an influence is weakening balance sheets in general, and people are getting nervous about their buyers. They're looking for cover. We're happy to provide that. And insolvency outlooks in general are either increasing or remain high in some developed markets. Now, for instance, in my home market, the Netherlands, there was a publication last week that the insolvencies will rise by some 60% in 2023 as compared to 2022. Yesterday, there was a publication that that overdue notifications in Central and Eastern Europe have increased by some 20%. These are not good signs. On the other hand, credit insurers are getting somewhat more selective in the risks that they underwrite. Having said that, aggregate capacity of the large underwriters is still some 20% higher than before the start of the COVID pandemic and before the start of last year, 2022. We're doing our jobs, we're underwriting, and that's what we need to do. If we look at the single and political risk segment, it's much more pronounced because it's so much smaller, right? But before we do that, let's take a look at claims in trade credit insurance. 66% increase, and that sounds dramatic. But please remember, the ratio of claims to premium is still in the low 30s. And that means that the loss ratios in 2021 were unnatural and unsustainable, owing to that large government support that we talked about earlier. And by this, I do not mean the reinsurance support that many states gave. I mean the support that governments gave to the real economy. Looking at this, if you dig down and if you look in different trade sectors in different countries, you do see differences. The acceptance rates seem to slope down a little bit in Q4 of 2022. And that has tended to be most visible in the construction-related sectors, where interest rate increases bite hardest. Now, coming to single and political risk, as I said, much more pronounced. Loss ratio is just under 28%, and that I do not see as unnatural, because I would expect the loss ratio in this segment to be much lower than in TCI in normal years, as the result is much more volatile. Turning our attention to surety. And what you see here is a mix of worldwide surety by our members, heavily influenced by the US market, being by far the largest surety market in the world. The results continue to be very benign, as they have been for a number of years. However, when I speak to my members, there are many more workout situations than there were in 2019, and I'll disregard 2020 and 2021 owing to the unnatural character. Now, workout situations, with that I mean where a loss is either imminent or the loss scenario becomes visible, and the surety, together with its contractor and the beneficiary, try to work out how a project can be delivered without a claim. The surety business is an 80-20 game. It's about 80% construction, bid bonds, performance bonds, maintenance bonds, advanced labor material, versus 20% commercial bonds. So license and customs bonds, judicial bonds, and a number of specialties which only occur in some countries or in a small number of countries, like pension bonds and social security bonds. This is because the surety market is highly national, takes all shapes and sizes, and even a bond that is called the same may mean something very different in very different markets. The example of that are housing bonds, which means a very different thing in Israel than it means in Spain. And I would like to point to our surety glossary of terms on our website. If you need to know what a bond is in a specific jurisdiction, have a look there. Now, the overriding issue in the surety market at this moment is inflation. We haven't seen inflation in Europe, in Asia, and in North America for probably a generation of underwriters. And what we see now is that inflation is putting strain on contractors because the contracts are usually fixed price. We did a webinar in January with panel members from Argentina, from Brazil, and from South Africa. People are used to inflation, and they pointed to some very good solutions, such as variable price contracts, but also spending much more time with your clients, with the contractors, with the beneficiaries to find out exactly how the business is doing and how they can help. But it's not only the construction surety business which has produced some scares. You can imagine that when a number of banks in the US, SVB, Signature, First Republic, started to slide, people became nervous. In the US, there is the Federal Deposit Insurance Company, which guarantees bank balances up to $250,000. Sureties have answered the call of the market and have guaranteed amounts above that, also for these three banks. Up to now, let's knock on wood, and not only for our sureties, those banks have not defaulted, but it certainly did cause a number of sleepless nights. If we look at the underlying trends, on the distribution side, a lot has happened. Brokers are investing in their distribution networks, and that can only be good for the market. It sees to a deeper penetration, but also gives clients, new and existing alike, a choice. That's good. It's a worldwide phenomenon. So we can see this in the Americas, in Asia, in Europe, where brokers are penetrating the market deeper than they did before. Another distribution mechanism for our industry are financial institutions, especially in Europe this time. It is an increasingly large customer group to our industry, and it uses our products to enable financing of trade. And it enables insurance on transactions which were previously uninsured, and therefore, at least for a part, not being done. As we'll see in the part on regulation, there is plenty of work to do in this segment, but I'll come to that later. If we look at new markets, India has for the first time recognized surety as an insurance product. It was exclusively a bank product. But given the volume of infrastructure investment in India, where the pipeline of infrastructure projects is worth $1.3 trillion in different stages of completion, and the budget for this budgetary period is $122 billion in outlay. Basically, banks and the governments cannot finance that by themselves. The call is to the surety industry to help. And we're talking about investments in railroads, in roads, in urban infrastructure, and in power. It's a starting line of business, and everyone is learning. The Indian Insurance Regulatory and Developmental Authority, IRDA, is learning, and we are working together under the flag of the International Surety Association, of which ICISA is a member, to educate, to bring information, to give them ideas. They are addressing challenges which resulted from earlier forms of regulation. They are addressing challenges in the form of the legal environment, which might, as it is, not be as conducive to surety as we would like it to be. This is not going to be a billion-dollar industry overnight, but we'll get there, slowly but surely. And the proof of the pudding you can see in China. So China, the surety market there took a long time to develop. We were talking about the Chinese surety market in the 90s already. Now, things have changed. That surety market had taken off in a big way since 2019. And that's not really surprising because the Chinese middle class is now a large and powerful demographic driving development of specialty classes like ours. If you look, some publications say that the middle class in China basically has the size of the entire US population. And if you see how it took off, underwriting year 2021 had treaties placed with a ceded volume of around 360 million euros. And that's coming from 64 million in 2018. That's a 5-fold increase, which doesn't look like it's slowing down. And also here, there is plenty of room to grow. So let's compare this, the Chinese market, to the largest surety market in Europe, and that's Italy. Now, estimates of the Italian surety markets are about 640 million for 100%. Compare that to the Chinese market, and you know it's going to be. In China, the loss ratios are decent, and the coverage is relatively standard, with construction bonds taking the lion's share, but also local development. One of the Chinese, call it specialties, is worker salary payment bonds. So a bond that guarantees that the employees of a company that has gone bankrupt actually get the pay that is due to them. Now, if we move to a different continent and a different subclass of business, trade credit insurance in Africa. Africa is often said to have a financing gap. I do not believe that is true. I think Africa has a collateral gap. If African companies have sufficient collateral to offer to their financial institutions, they will get financed. And trade credit insurance policies is one of the prime sources of these collaterals. Now, this is only just starting, and again, is not going to develop overnight. And what we need to recognize are the local circumstances. We cannot simply transplant trade credit insurance from Europe or from the Americas into Africa. It's not going to work. We will need different solutions. We will need different ways of doing business. And ICISA is paving the way together with other institutions. We cooperate with people like FCI, the factoring people, who actually provide direct financing under our cover, with official bodies such as a Bank. And there are challenges. And the prime challenges, if I talk to my members, is the acquisition of underwriting information, the rule of law, and I don't mean only that there are laws in these countries, but also the way in which they are maintained by the courts, and predictability, which is a code word for corruption. If we do not have a predictable environment, it is hard to do business. Turning to new products, we have seen the energy transition being transformed into legislation. And I'm talking about the Inflation Reduction Act in the US and the Green Energy New Deal in the EU, and lots of other initiatives elsewhere. And that will necessarily lead to new business. ICISA has a cooperation with the Basel Agency for Sustainable Energy, BASE, which develops renewable energy projects for which they need bonds. And we're all too happy to be the linking pin between this institution and our market. We also see our members develop all kinds of products which fit today's market, such as energy shortfall bonds or margin variation guarantees, enabling the trade and clearing of energy and other essential commodities for our economies. If we look at the underlying trend in the reinsurance sector, we have seen for the renewal 2023 the fallout of Hurricane Ian and other hurricanes and floods, where, according to Reuters, the insured exposure totaled $120 billion in 2022. What does that mean? It means that reinsurance companies have paid out losses, formed reserves, and that capital is getting just that little bit scarcer. Lines of business within reinsurance companies are having to compete for that capital. But we've got an advantage as credit and surety industry. According to one report, the underlying performance in the period 2020 to 2022, our performance was extremely good, with NCOR's combined operating ratios in the low 80s. And that gives confidence. 2022 was a particularly good year for many reinsurers in this sector, with COVID reserves being released. Remember, it was supposed to be Armageddon, so reinsurance companies formed reserves, which were, but we only saw this later, not really necessary. So these reserves were partly or largely redeployed in, for instance, the property business to smooth results and maintain core profitability of those reinsurance companies. By comparison, credit and surety as a line looks brilliant. Now, at the start or during the renewal of 2023, reinsurance capacity was still adequate. And that has been the case for as long as at least I can remember. We've seen peaks, 2015, 2016, where capacity was flush. And we've seen troughs in 2009 and 21. 2009 being the global financial crisis, 2021, COVID, right? At the moment, due to the competition for capital I just described, capacity is by no means flush, but it's still there. But a little bit more economical behavior was seen. Air capacity was withdrawn for some part. And the pricing environment, at least on the proportional side, was slightly to the advantage of reinsurers, with renewal conditions remaining largely stable for programs renewing as expiring. But there's always a but, right? Inflation is starting to bite. There are higher needs for limits due to inflation, and that necessarily translates into higher reinsurance limits and or usage. And there are signs that we are starting to see the end of market capacity on peak risks. Signs, not real cases yet. And this we see as a task for ICISA to explain to the risk managers and the actuaries in reinsurance company what the relationship is between reinsurance capacity given and ultimate net loss. For that, we do an LGD study, a study into the loss given default of trade credit insurance exposure, and we hope to publish them for underwriting years 2017 to 2019 at the end of summer. Let's turn to regulation. 3 topics. Solvency II, ever important, right? And the common mistake is that Solvency II is only applicable to the European Union. Think again. Solvency II is already followed by a large number of countries across the world, maybe not to the letter, but certainly to the spirit. And the IAIS, the International Association of Insurance Supervisors, launched its final consultation for international capital standards yesterday, ahead of its adoption in 2024. And it looks a lot like Solvency II. It has a lot of bearing on capacity and on pricing, because the more capital you have to hold, the tighter the capacity and the higher the pricing becomes. And the major topics of discussions are now internal models, which I'm not going to bore you with, and the parameters with which the Solvency II model is calibrated. And they have not been recalibrated since the implementation in 2016. Today, where we are is regulators having expressed their willingness to look at the parameters again based on solid industry data. That's important. It's important because the world moves on, and it's important because in the first place, those parameters were fixed on totally different things, or partly different things, than our industry, but also on financial guarantee, mortgage indemnity, agricultural credit. What we would like to see is our industry reflected in these parameters. A big topic is Basel regulation. And I said financial institutions as buyers of our products in both trade credit insurance and surety is getting more and more important. The sector has been growing steadily, and an estimate of the IACPM, the International Association of Credit Portfolio Managers, they show that credit risk insurance, of which trade credit insurance is one product, is second in the ranking of how banks seek to relieve themselves of risk capital. And that's only slightly behind bank syndication. 10 years ago, it was nowhere near. So it is a big product. Bank lending facilitated by credit risk insurance amounts to 158 billion euros in May 2019. And this enabled some 600 billion in lending. Having said that, Basel never explicitly recognized trade credit insurance as a capital relief mechanism. It's treated as a corporate guarantee, which we think is pretty unfair. Because first, insurance companies are regulated, and they're regulated heavily, other than just any corporate. And secondly, in many or most jurisdictions, policyholder protection is enshrined in the law. What does that mean? If a credit insurer were to go bankrupt, which hasn't happened since the start of the 90s, policyholders stand a very good chance of getting their indemnification as due. There is a discussion focusing around conditionality of the policy. Some parties are strict in saying that no exclusion may be made when that exclusion falls outside the sphere of influence of the bank or financial institutions. Although regulators have mentioned that this is really a question of materiality. Now, that is exactly what we're looking at together with a reinsurance broker an actuarial firm and a law firm in the case of nuclear risk. How material is it? EU institutions allegedly came to an agreement on the Capital Risk Directive and capital risk regulation last night. We don't know what's in it yet. We're knocking on wood. We've been talking a lot with these regulators. The UK is in the process, after a consultation process to which ICISA contributed in cooperation with other trade sector bodies like the LMA, the IUA, and the ABI. This is a major challenge for our industry, as is sustainability. And it is not only a challenge for our industry, it is the challenge. It is increasingly in the focus of our members, and our members are working hard to contribute to the overall sustainability targets that are enshrined in the Paris Accords. There's a difference between short-term trade credit on the one hand and medium and long-term credit and surety on the other. Simply a question of volume. On the short-term credit side, there are lots of very, very small risks, and they need to be tested, and we need a methodology for that. We are working on that together with the Partnership for Carbon Accounting Financials. Again, look at last month's webinar. And I mentioned the initiative that we have deployed together with BASE. In Brussels, 3 weeks ago, AM Best held a presentation and said sustainability is clearly an input to our rating models. If we come to the outlook, where's the economy going? If only I knew, I probably wouldn't be sitting here, right? But pointers are that we're up for a more difficult period, given inflation and given interest rates. However, our industry is adaptable and better at credit risk management than it has ever been. We see that insolvencies are rising. They are not at a level yet where people are holding on to their chairs, but they'll get there and we'll manage it. But we can see that, for instance, highly leveraged companies are a segment where there is a little less capacity now. Now, given professionalism and the profitability over the cycle, I have no doubt on the staying power of insurers and reinsurers alike. Turning to digital initiative. They're the buzzwords at the moment, right? AI, platform business. And AI is not new to this industry. Statistical underwriting has been prevalent for decades, and this is a natural progression. And I see that a number of our members are investing quite heavily in this form of technology. We're interested, we follow it, we don't get involved because this is a competitive topic, and ICISA is a non or pre-competitive institution. Members are investing in proprietary technology or in tech companies, and that's the way it should be. We see a few startup insurers / MGAs focusing on purely digital ways of doing business, and we see that as a very healthy development. We are not static. And from this, new skills are coming into the market. And I would like to highlight Aon Re's initiative and thank them for organizing a program for the younger generation in our industry. If everyone has the same hair color as I do, no good is going to come of that in 10 or 20 years. Is important, as are diversity initiatives, which I see within ICISA, but also between and within our members. We're a dynamic sector of insurance, although this might be a contradiction in terms, according to some people. But we're adapting, we're changing, and we're changing for the better. We see greater levels of interest in ICISA amongst people who are not or not yet members, because we share best practice in the industry and everyone stands to gain. Not only the insurance and reinsurance companies, but clients, first and foremost. We're here to stay, and we serve our clients and the society at large. This is how we see our industry. And here is your opportunity to ask or to have asked questions. So I am looking. And I see one question. Could you please comment on perspectives for the Latin American surety market? I'd love to, but I would like to wave this question on to my colleagues at the Pan American Surety Association. They have such deep insights in the Latin American surety market. We have members there. I know they are doing well. I know they are developing well, but PASA is probably the better association to answer this. The second question. An interesting one from somebody in the audience called Danny B. Do you think the lessons have been learned from the green cell situation? Commonly referred as the G word, right? There is not a meeting or a symposium I went to over the last 24 months where the G word has not been mentioned. Now, the green cell situation, I think, yes, lessons have been learned. And I think people pretty much accept that this was not a faulty credit insurance product. It was probably, amongst others, a clear case of bad underwriting. So yes, I think lessons have been learned. I think it was only one underwriter who was involved in that up to the end. That underwriter is basically gone. Oh, and incidentally, there was an inquiry in the UK into the green cell situation and to look whether they should do something about trade credit insurance. Their conclusion was the same thing. Faulty underwriting in this case, and that's where we'll leave it. The question, if peak reinsurance is being withdrawn, is there a possibility to look at alternative cat bonds, etc.? Yes, Chris, there is. And that possibility has always been there. We have seen one cat bond in our industry that I know of. We have seen credit default swaps being bought for peak risks. At the moment, it is not necessary. At the moment, we think it is more an educational topic than anything else. Is there. The reason why they preferably are not adopted by the buyers of reinsurance is that they're more expensive, pure and simple. Another question. Do you expect overall increased surety premium interest rates to increase as also bank interest level increases, or do you think it will stay flat? This is a good question, and when you look at the premium rates in our market, in any insurance market, it is it results from the risk profile of the companies, which might or might not suffer from interest rate rises. It is also a competitive subject. If somebody wants to gain market share, prices are usually pushed down. What we see at the moment is, or what we have seen in the past, is that prices do not go up as steeply as they do with banks, but that the portion of the surety market in the overall guarantee market tends to increase and tends to be kind of sticky. So whether the surety premium will increase, could be. Whether the surety volume will increase, yes, I expect it to do so. Question from Chris. Do you see non-cancellation cover gaining greater prominence? Non-can, I don't think I have to explain it to the audience. We did explain it to the European Systemic Risk Board, who said non-can might be a good way to fix a possible market failing where if the bottom drops out of the market, credit insurers decrease their limit volume in a big way. Now, first of all, that hasn't happened. What we saw at the lowest point after the start of the COVID pandemic is that capacity decreased by some 10%. Yes, that's notable, but it's not catastrophic. Secondly of all, non-cancelable cover is non-cancelable as long as the policy runs. And the policy can be terminated by an insurer. So really non-can cover, I have never seen in my life. Does it gain greater prominence? Could, especially in the larger segment, where the ESRB recommended it as a solution is in the SME segment, where I don't think it's going to gain greater prominence. I haven't seen it and I don't expect it. Another question. How do you see the relationship between credit insurance companies and banks evolving? Do we still see them as competition or do we see them as partners? What we've seen evolving over the past years is that banks are using credit insurance companies as a capital relief mechanism, and we're happy to do that. Risk is spread not only within the banking sector, but also outside it, and that promotes general resilience. Do we see them as competition? Yeah, of course. They are complementary products in some markets, in some sorts. And that is something we've learned to live with. What I have seen evolving is that at the start of the 90s until the mid of the 90s, banks were generally distrusted. They were generally seen as people wanting to shove bad risks to the insurance market so they could profit from their insurance policy. I think that has changed remarkably. Banks are sharing risks. Underwriters know what they are accepting. So it's become much more of a partnership than it ever was. How it'll evolve is at least partly a result of the Basel 3.1 regulation, which is to come our way. You pointed to the growth of business from banks to credit insurance sector. Are you concerned about the quality of risk being transferred, and how is that relationship managed properly? Answer that question partly. I think the quality of risk is pretty good on the whole. Some research has shown that banks produce, by and large, the same loss ratio as corporates do. Relationship, is it managed properly? Yeah, I think it is. And the management of that relationship is a two-sided thing. It is both the mentality of the bank treating the insurance companies as worthwhile partners, and I see that. And it is also the credit insurer knowing exactly what it accepts, what it can accept, and what it should not accept. So I see that relationship on the whole managed pretty well. Again, the big exception to this was Greensill, where one of the parties was clearly out to take advantage of the other one, and the other party didn't notice. That was one piece of business, and I haven't seen it repeated since, and I hope that lasts for a very long time. Those were the questions. Any last moment ones? We have 2 to the hour, according to my computer. And here's your chance. If not, I would like to thank you for your attention. On screen, maybe a little bigger if we can do that. You see our email address and our telephone. And as my Canadian colleague said a couple of weeks ago at our conference, call us. We tend to get lonely. Now, if there's anything we can do for you, please do call us. Please do write to us. We're happy to help. With that, here's ICISA Richard Wulff signing off from Schiphol Airport near Amsterdam, and we hope to see all of you soon. Thank you so much.